Hi there, it's Corey here, CEO at Verse Wealth, and today we're here for our quarterly market update, and I'm joined once again by the familiar face from Drummond Capital of Tom Schubert. Tom, thank you for joining us.
Hi, Corey. Great to be here. Thanks for having me again.
Yeah, you are most welcome. So we've got plenty to cover today, as we normally do when we get you. We want your views, I guess, on the current state of the economy, the current state of investment markets, perhaps what might be in store for 2023. So we're going to be talking about things like big tech, inflation, interest rates, the US debt ceiling, which is a headline seemingly once again. And we might finish with a bit of a conversation around AI. Your views on how it might influence investing into the future. So plenty to get through there, Tom. So let's start at the top. Can you just, I guess, give us some insight into what's been driving investment markets so far in 2022? We do know the markets that had some good gains this year on the back of negative returns last year. The US market's up 8% for the year. The Australian market, the order is up 4%. And the US tech market, the NASDAQ, is up 22%. So far this year after a pretty challenging 2022.
Yeah, thanks, Graham. And you call out the numbers that really are the major drivers this year. It's been there's a lot of competing forces. I think it's probably the first thing to outline in markets. We're sort of coming off the back of a weak 2022, and so naturally there's some value around in parts of the market. We had positive surprises, particularly like China reopening and sort of accelerating in terms of their growth profile this year. So that's been a boost for the global economy. The resilience of the US consumer and the US economy has certainly been one of the big factors. But largely all of the returns this year have been driven by just a handful of stocks. And that is those big tech names, hence the NASDAQ performing so well. So we think that's two things. One, they were the weakest names last year, so there is just some natural recovery. Secondly, relatively more defensive earnings than other parts of the market. There's been particular weakness in the banking sector, for example. Commodity prices have fallen back, and so some of the more cyclical parts of the market have been under pressure, and so the more defensive parts of tech earnings have been sought after. But really, we think the big driver, we said we'll have a conversation a little bit more about this later, has been AI and the sort of flight towards any business, if you will, that can benefit from AI. And so if we look at the majority of the return in both US equities and indeed global equities so far in calendar year 2020 has really come from about 5 stocks. It's Google, it's Amazon, Facebook, Microsoft, and Nvidia, which makes memory chips. All of those businesses are sent in order for any business to incorporate AI. They need more cloud infrastructure. So you need more processing power in the cloud. And so the big cloud businesses and tech companies that supply to that are in the short term, at least, the primary beneficiaries. If you look under the hood, it's a very different story. And so the market cap weighted, so index this year is up, but the actual equal weighted, so the average stock in the US is actually down. So we're coming through, we've just had quarterly earnings in the US, and actually year-on-year earnings in aggregate fell 5.5%. So it's starting to show that economic weakness, slowing economy coming through. But at a headline level, the index is up, and it's really just been driven by those big tech names.
Yeah, I think that that's a really important bit of nuance there, because we tend to really just kind of see and consume the headlines, and they're the ones that we use as our reference point for our views. But like you're saying, this it's a very small portion of markets, those 5 big tech companies that you referred to, that have had these kind of positive earnings results that have surprised markets. But more generally, as you say, under the hood, companies beginning to feel the weight of the the economic slowdown. So with that in mind, just think about the conversations we've had over the last 3, 6, 9 months as interest rates here and globally have begun to rise to kind of curb inflation. You've been talking about the fact that we're going to see a slowdown. It's a matter of when and what severity, and there's a looming prospect of a recession. And your views were that at some point we're going to see earnings really begin to take this hit, and you've just kind of given us a bit of a nuanced insight into what that hit actually looks like. Has that changed your perspective on what the slowdown is or is going to look like in the prospect of a recession?
Yeah, we think we're getting closer to that point now. And again, so earnings were negative for the quarter we just had, and estimates for the earnings for the year have been cut, so that overall in 2023, we're now going to have lower earnings than 2022. And so, that's a sign of the pace of rate hikes starting to flow through. I think the other thing, in January, some of the early sort of bullishness in markets was driven by expectation that headline inflation was coming down, and therefore central banks were largely done easing. You spoke about the surprise that everyone had to the RBA hiking rates this month, but it wasn't that same week. The Federal Reserve in the US hiked again, the European Central Bank hiked again. And so, even though we've seen headline inflation moderate, core inflation, which is like rent and wages and sticky components, and the measure that the central banks are really focused on, is sort of 2 or 3% above their target still. So they still have work to get core inflation down to target. So from kind of 5% to 2%, if you will. So despite, higher rates starting to break things with, there's headlines in March in particular and April around some of the regional banks in the US going bust, getting bailed out. They're quite big in terms of their size, not systemically relevant, like they're not a JP Morgan or Bank of America. It's not a GFC, but they're still big in terms of the size they bank to small business and the general economy. But again, just signs of the pressure that is caused, is being put on the economy through these rapid rate hikes. And yet, despite that, the Fed hiked rates in March and they hiked rates again in April and May. And so even though you've got weakness in the banking system, they're committed very much to getting inflation under control. So if anything, we think now we're seeing the signs of the weakness, that earnings are falling, growth is slowing, and credit conditions are really tightening. So availability of credit at a consumer level, at a business level, and in particular a small business level, was really getting tighter, and that generally leads slower activity ahead. And so outside of those big tech stocks, where we do have exposure in the portfolios, and we have actually increased some exposure to the portfolios, and we're doing more work on trying to understand how big the potential AI earnings story could be in that relatively narrow but important part of the market. The rest of the market is actually showing signs of that sort of economic slowdown into recession kind of weak period. And so we remain, at least with that in mind, more defensively positioned.
So with that in mind, would it be fair to make the assumption that perhaps your belief is that markets are currently positioned overly optimistically in the face of this ongoing sticky inflation, the prospect of potentially more rate hikes in the future, a further economic slowdown pending? Have we all not taken enough stock of some of these variables?
It would be correct. There's a confluence of factors that are all lining up against the market, and in of themselves, we think that they are explainable. But when you put them all together, I think a lot of leading indicators we're seeing, you've basically never had this pace of rate hikes, this tighter credit conditions, this level of inverted yield curves, the initial jobless claims starting to spike, like so on and so forth. This tightening of credit and liquidity that we're seeing, it's like you got to go back to the 1930s to see this pace of withdrawal. You've never had all of those things happen and you not have a recession. So it would be different this time, and they're very dangerous words in finance. And so with history as a guide, we think that is the most likely outcome. We're not thinking it's a COVID style or GFC style recession, but earnings will fall between 10 and 20%. And right now they're on that way. They're on the way. They're down 5% for the quarter. They've probably got a bit further to go, but the stock market as a whole hasn't largely discounted all of that yet. So we think, given that outlook, and we're getting closer to that point now, it actually is going to present all the great buying opportunities. So we think we're getting really close to that point of being able to go, okay, market gets weak, we'll really start to aggressively deploy some of that dry powder and cash that we're holding.
Yeah, certainly. Well, certainly the strategy requires a lot of patience. So credit to you for having that in abundance. In terms of outlook, so specifically on interest rates, as you said, RBA paused rates for the first time in April, and seemingly to most people's surprise, hiked them by 25 basis points in May. So we've got a cash rate of 3.85%. What are your views on where that is going from here, and why?
Given the slowdown in the economy, we think that they're getting closer to the end of the hiking cycle. But there's two important factors here. I think a lot of people were hoping not just for them to end hiking, but to start easing. Be careful what you wish for. We think there's probably another hike to come from the RBA, from the Fed. Again, just watch what they're doing. Like, inflation is above core. And despite all of this weakness out there in the banking system and uncertainty, they're still hiking. And so that shows that they're razor focused on that inflation number. And as long as it's above target, they're still hiking. And so we think there's another hike to come at least. From there, the only way you get material rate cuts, at least this year, is if you have a really bad outcome in the markets and the economy. So let's not hope for that outcome. But indeed, if you do get a sort of the mild recession and markets roll off this year, then potentially next year, if they almost need that recession to get inflation down. Like, if you look at their own forecast, they're anticipating unemployment to go from sort of 3.5 to 4.5 or 5. Like, that is a recession, basically, even though it's not that high versus historical. That's the sort of pressure they need to alleviate from the economy to get that inflation rate down. And so they're very focused on that. Once they achieve that, then they'll start easing rates again into the new year, we think. So, yeah, this year, unlikely to see probably another hike and then flatline. And then as the economy slows, markets roll off, we get those cuts into next year. And all of that is great from an equity market standpoint. You get the sell-off, and then when you start getting the cuts, it's a great reset on the bull market on the other side. And that's what we want to get positioned for.
Yeah, if we've got a bull market on the other side of a slowdown, and that bull market is spurred by progressive rate cuts, maybe a full percentage point over the course of 12 months, that's typically going to be pretty favorable conditions for investment markets. One last question, hopefully a quick response from you, RE interest rates. So the RBA is currently talking about getting inflation back to within its target band of 2 to 3%. I think currently the annual rate is like 6.6%. They think they can get back there by 2025. So that's 2 years away. What are your views on how realistic that actually might be?
We think they'll get down. We just think that we've spent 10 years with inflation below target. They spent a long time trying to stimulate cut rates to get it up to the 2. And we think, in simple terms now, central banks are going to spend the next 10 years defending the top of the band. So demographics, deglobalization, decarbonisation, defence spending, all of these things require huge amounts of capital investment, are quite inflationary. And so they've sort of got some structural headwinds of, inflation volatility. And so, yes, rates may be cut, but I just don't think we're going back to the 0-1% style rates that we experienced for that. They were very unusual. We're now going back to a more normal interest rate environment. And from an investment perspective, that's a good thing.
Yeah, well said. We've had, just thinking back to the last 3-4 years on the back of COVID, it's been some very, very unusual times and very unusual scenarios to deal with. So shifting gears a little bit. So in recent weeks, we've seen the return of headlines around a potential default on US government debt. I feel like I've seen this story many times before. Going back to the early years post-GFC under the Obama administration, I think that was the first time, perhaps in a long time, they kind of hit their debt ceiling, and it was headlines for a few weeks, and then seemingly, from afar, kind of resolved itself. And they've kind of hit that ceiling multiple times before under different, administrations since. So I think that ceiling is pending again. What's happening this time? Is it anything different to the past, and is it something that we should actually be worried about?
We should always worry about it, but to the extent that history tells us that they get it done one way or another. And so, as you allude to, we've been here many times before. There's a great chart that I could share with you for afterwards if you like, which going back and looking at the debt ceiling from the 1940s all the way through today. It was about $5 trillion in the start of 2000 under George W. Bush, and rose to 10, funding his wars. Then the GFC hit, and Obama was elected, and it rose from 10 to 20. and then Trump was elected, and he put in all those tax cuts, and then had COVID, and it went to 25, and then Biden got in and did more stimulus for COVID, and now we're at 30. And so doesn't matter whether it's Republican or Democrat, over time it's gone up, and they continue to spend. Look, it will reach a stage where there's a broad concern about just the size of the debt pool in the US, and I think that's something that is, every time they do it, we sort of go, oh, are they ever going to get the fiscal position under control? Like, that becomes a bigger question. And it's always political. I think at the moment there's, in the US, they're staring down a full presidential election in 2024. So they want to stand off, and typically Republicans want lower spending and Democrats want higher taxes. And so they disagree until the end, and then they get some sort of deal done. Just given the vulnerabilities in the system at the moment, so the banking system in the US a little fragile, given the slowdown in the economy and also elevated valuations. Like, there's not a lot of kind of room for error, if that makes sense. So given all the other things going on, if they do stand off against each other like they did in 2011. That was the last time we had a real standoff and actually laid off some of the public sector. The market fell 18%. So we have some reason to worry about that. For us, that's an opportunity, right? That's one of the catalysts we may use to be able to get back in at cheaper prices. But otherwise, most of the time, it's nothing to worry about other than headlines. Politics.
Yeah, sure. Yeah, I think you just re-jogged my memory there. I think they had like a government shutdown for a week or two, but back in the days, let's say 2011. So, base case is they'll get that sorted out, but in the interim, it might create some volatility in markets, and that might potentially for some credit buying opportunities. So, last question for you, last topic for today is AI. For those not familiar with the term, I'm not sure there's going to be anyone, but that is artificial intelligence. It has been the water cooler conversation, I think, of 2023 so far. That's really on the back of the coming out moment of Chat GPT and the generative AI tool that they've got. We've kind of already begun using that in Verse for some productivity gains. There's been so much debate really everywhere around the likely productivity benefits, and really potentially an age of abundance being a result of AI, but also down the other end of the spectrum, and rightly so, there's some really strong fears and concerns around what AI can do from a negative perspective, and some kind of saying it could be the end of humanity. I know that sounds extreme, but there's this this scenario of when the robots take over, where does that leave us humans? So that's getting pretty broad. I guess what I'm keen to know from you, Tom, is what are your views on AI and how it might shape the future, but perhaps in particular how that might be a theme influencing investing moving forward from here.
Yeah, sure. So I agree there's definitely concerns around the regulation side of the equation, but the reality is it's here to stay. It's been bubbling away in the background, and now it's in the foreground. And human race has been forever resistant to technological change. I think it was Queen Elizabeth in the 1500s banned a patent on a sewing machine for fear of putting out of manual sewers. In the Industrial Revolution of the 1700s, massive fear that machines were going to replace labour. And yet here we are in the 2000s, and all of the jobs that were essentially in existence in the 1700s are no longer with us, and the unemployment rate is lower. And so over time, technology's actually driven higher standard of living, essentially, and new jobs have been created through new innovation. And so I think we need to accept that it's here and embrace it. And I certainly think some form of regulation around that's going to be important. But we need to accept it and try and, as you say, find ways to make us all more productive, which is a benefit for us all. And so from an investment perspective, we accept that it is here. So there's no point, ignoring that. That's the first thing. It's here. And so how do we benefit from it? Which industries? And I think this is the big thing. The question is twofold. The long-term growth implications, because if it largely can benefit all industries from an efficiency point of view, it actually lifts productivity growth and long-term potential economic growth. And that's a long-term scenario we've got in our strategic asset allocation review this year. We're calling it an AI boom. And it's a little bit like the 1990s. So the advent of the personal computer coming into our life and then onto smartphones and all of those wonderful productivity gains we experienced through the 90s and the start of the noughties, potentially replicated again now through AI. So it's the next stage of innovation and tech advancement. So that's one sort of global factor. And then secondly, specifically, I guess, which sectors in tech are going to benefit from this? And at first glance, and certainly the market is in agreement with this, partly with our earlier conversation, the big tech companies, if you're actually wanting to implement AI in your business or use these tools, Google and Amazon and Azure, like Microsoft in the cloud, actually have really, really advanced AI technology already and the infrastructure up there to enable you to implement. So yet again, big tech looks like it's going to be a winner from this. And some of the, again, the smaller tech companies, I'm sure there's going to be a lot of new emergent startups in the space. And we've seen some interesting ideas there, but largely at the moment, it looks to be quite narrow in terms of the beneficiaries. But that's something that we'll stay really close to and try and make sure we've got some exposure to in the portfolios.
Well, thanks for your insight, Tom. And I think it's quite easy to say that if we fast forward just a couple of years or 5+ years, that so many of the big tech or the heavyweights on markets are going to be AI-based businesses. So I think we've covered enough ground for today, Tom. We've covered plenty of ground, in fact. Thank you, as always, for your insights and for your time. We'll have you back on next quarter, but we appreciate you being here today and look forward to talking to you next time.
Thanks, Corey. Great to chat.
Cheers, Tom.
Cheers.